bond spreads. Now, we talked about this a little bit when we were talking about interest rates earlier. Now, bond spreads or yield spreads are the differences between the country's interest rates. Currencies with higher yields are more attractive to foreign investors, while currencies with lower yields are less attractive. Okay, so the currencies with higher yields are going to attract more flows. Analyzing the difference or spread in these rates can help some long-term investors pair currencies to trade. Now, this is more of a long-term strategy and not particularly useful for short-term trading. Also, when you have the large differences in interest rates, that leads to what we call the carry trade, where investors buy one currency that is paying a higher interest rate and fund it with another that is paying a lower interest rate, creating a positive carry. This has been a very common trade over the years with the Japanese yen, and you may have heard of this. I remember not as much now since Australia has lowered their interest rates, but at one point the Australian dollar was the poster child for a carry trade. Basically, if you were long the Aussie yen, you were in a carry trade. Now, obviously, this was back a little while ago before the RBA started to cut their rates, when they still had rates over 4% and the Japanese yen was at 0. So basically, folks that were buying the Aussie yen, they were long the Aussie yen and holding that, they were getting paid interest on that position, and with the leverage in the Forex market, you weren't only getting paid interest for your smaller position, you were actually getting paid interest on the entire leveraged position. Now, obviously, the risk to that trade was the currency fluctuation. If the Aussie declined against the yen and you're highly leveraged, you could be in trouble. And that's when you'll start to hear terms like the unwinding of the carry trade, when the Japanese yen started to strengthen against some of those higher yielding currencies. Okay, so anyway, bond spreads, we know interest rates drive currency, so a big difference in the interest rates can help you to pair currencies together. Again, it's a long-term strategy, and you're going to have to really focus on monetary policy at that point if that's the kind of trades you're taking.